Hi, this is Brian Nick, head of portfolio strategy for NewEdge Wealth. I want to take you through a couple of slides that we're going to be using in an upcoming weekly Edge piece. Well, there'll be a lot more detail and information, but some interesting things happening in the economy, not just recently, but over the last several years that look very different from what we're used to seeing. We're seeing softening economic data, softening growth, but we've been seeing it for many, many years now, which is not typical, as I'll show in the next couple of slides. And one of the things that this reminded me of is this 2006, this beautiful little movie called Once. The music in that movie actually won an Oscar for Best Song, and the name of the song was Falling Slowly. And that feels like what's happening right now to the economy in the US. But the thing that we also want to stress is that the markets don't seem to be as troubled by the evident weakness in some of the data as many economists would seem to be. A couple of illustrations here for how to look at the economy over a period of several years, and then kind of drilling down into what's been happening in the last several months. One of the things we want to look at is consumers' assessment of the economy. Do people say the current economic situation is good or not so good? And you can see that these things tend to be very cyclical. People say that things are going well and are actually improving until they're not, and then they get worse very, very quickly. So this black line is representing consumer sentiment. And you can see that the last couple of years just don't look like the rest of this series. Instead of there being sort of these peaks and valleys, we've been in this sort of jagged downward move, and that's very atypical. Usually, once things stop getting better, they start getting worse very quickly. Instead, we have consumers assessing the economy has been getting worse for several years, but not in a rapid fashion. We also see that, and this may be explaining some of what's happening with consumer attitudes. We've seen that in the labor market as well. When the number of unemployed people in the labor market goes up, it tends to go up very quickly, and it tends to go up coincident with a recession. That has also not been the case here. We know the unemployment rate was 3.4% a couple of years ago now. It's now only 4.1%. That's a significant increase in the unemployment rate, but not over as long a period of time as we've seen. It's been very, very gentle. And the absolute number of unemployed people actually went down in the month of June, but had been going up prior to that. Again, very unusual to see a rise in unemployment this slowly, and a rise in unemployment that has not coincided with an increased risk of recession. But one thing we are starting to see change is actual consumer behavior starting to mirror consumer sentiment. For a while, we were getting away with this idea that people were reporting their attitudes of the economy as being very poor, but they weren't actually reflecting that behavior in their own spending habits. This year so far, if we look at sort of the annualized rate of spending change over the first 5 months of this year, and we go back and we look at other 5 month periods, for the first time since the very kind of early recovery period from the global financial crisis in the late 2000s, early 2010s, we're seeing this turn negative over a significant period of time. Some of this behavior is warped by the tariffs. For example, a lot of people bought cars in February and March and didn't buy cars in April, May, and June because of the tariffs and the associated risks with paying higher prices potentially. But when we go over a long enough period of time now, stretch this out, we are seeing consumer behavior start to get weaker, although nowhere near as weak, obviously, as it was during the last significant recession, or obviously during COVID as well, which I don't even show on this graph because the scales would be so small. The other thing that we're seeing, which is quite unusual, is home prices have started to fall. Now, if you have been keeping track of what interest rates have been doing for the last couple of years, this probably isn't a huge shock. But people have become very used to seeing home price appreciation, sellers getting more than they're asking for on their homes. That's happening with less and less frequency now across the country. And over the last, again, 3 months, the average home price in the United States has actually fallen. Now, we only saw this briefly with the first onset of very high interest rates in 2022, but then home prices started to snap back again. And obviously, with the prolonged period of home price declines around the global financial crisis. Again, people are probably not feeling this yet in their wallets and their pocketbooks. A small decrease in home prices after a period of rapid appreciation is not going to wreck the economy, but it could be contributing to consumer attitudes about the economy and their eventual spending behavior. But we have to turn to markets here and acknowledge that all the weakness I've been talking about is not really reflected at all in the pricing of financial assets. Here you're looking at credit spreads on both investment grade and high yield corporate bonds. Those had gapped out in April with the concern about recession risk around Liberation Day and the announcement of the tariffs. Those have more or less come all the way back down. Spreads are now at multi-year tights or close to multi-year tights again, meaning that there's no concern in the credit market about increased risk of defaults or other kinds of financial stress on the parts of businesses. And individual investors have now become more bullish again on the equity market. Individual investors tend to be pretty good contrarian indicators. When they get very, very bullish, it's usually a time that you want to be a bit more cautious. And when they get bearish, it's a time that you typically want to buy. That certainly was the case this spring when investors reported close to their most bearish attitudes ever. You can see that blue line was cratering down and spiked downward. That ended up being a very good buying opportunity. As we've seen the stock market rise, consumer and individual investor behaviors about the stock market have improved. They're not at extreme bullish territory anymore, but they're back above that Mendoza line, which is extremely interesting. So the question for the next couple of months of data is, do we see the economy continue to soften? And does that start to impact investor behavior? We know consumers are pulling back a bit. We know home prices have pulled back a bit. We know businesses aren't hiring as much as they were. But none of these things are happening all that frequently or in ways that should alarm us. What will start to happen if the data gets worse is you could see the reaction in the markets, and that becomes a self-fulfilling downward spiral. So that's what we're going to be watching over the summer. The economic data is more important than ever, especially the data around consumers and the labor market, and we'll be back to talk more about it.